All right, perfect, perfect. Well, thank you all for being here today. I know it's a holiday. Some of you didn't have work, so I appreciate you taking time out of your night to be here. Today's presentation is just to go over some year-end tax strategies that you can implement for your business to ultimately reduce your tax bill. So that's the goal here, right? So introduction, because there's a couple new faces here, folks I haven't seen before. My name is Darian Wiggs. I'm a licensed certified public accountant and I'm the founder and CEO of Wiggs CPA Tax and Accounting, which is a virtual tax firm that was started in Chicago, Illinois, but currently right now in Denver. But we still serve business owners and everyone throughout the United States. So business was launched October 20th, 2022. So relatively just reached 3 years. As far as education background, I do have a master's degree and a bachelor's degree with a concentration in real estate from the University of Illinois. So not just a random guy on the internet giving out tax strategies. I actually went to school for it. And then I'm also passionate about teaching. I love doing webinars like this. I try to do them as much as I can, just so I can do my part in giving back and teaching my community, friends, family, and other business owners as much as I can about finances and taxes so you can essentially keep more money in your pocket. So let's get started. So today, as I mentioned, is to talk about taxes. So I always got to get an introductory to what taxes are, right? At the end of the day, taxes is something that's almost impossible to avoid. And big reason why, we all going through this governmental shutdown and because of budgets and things like that. And taxes play a huge role in the economy because it funds a lot of the infrastructure we have, the governmental program, environmental programs, the protection we have. All that good stuff is funded through taxes. So when you do the math and you look at the average American, on average, everyone here, unless you have a very good advisor like myself and been working with me all year, you're paying about 30 to 40% of your income to taxes. And that's not just federal taxes. You got to think about federal taxes, state taxes, property tax, sales tax, liquor tax, Medicare tax, like the list goes on and on. So even when you step outside and you're not thinking about, oh, Uncle Sam, like you're still paying some type of state and governmental taxes. As a result, the average American is paying about close to about 30 to 40% of our income in taxes. And if your income is even higher, especially those of you with majority of your income coming from W-2 wages, you're going to pay a majority of your income in taxes, right? But the goal with us, and especially at Wiggs CPA Tax and Accounting, is we understand taxes are important, but the biggest tax that we all pay is the tax of not knowing. So thank you all again for being here because I'm going to try to encourage you all to learn a little bit more and teach you throughout this process because the goal is to pay some taxes, but never more than your fair share, right? So that's pretty much the backstory on taxes. But what we're here to talk about today is the importance of understanding that there's two different tax seasons. We all know about tax prep season. That's when you come to your accountant, January, February, March, April. You give me your tax documents and I tell you what you owe, right? And Wiggs CPA Tax and Accounting, we try our best to tell you where you can squeeze expenses. But the reality is most people only mess with their tax bill during tax prep season. But what I'm here to educate you all about today is tax planning season. That's the second tax season. That's when the wealthiest individuals, especially those who are business owners, that's me encouraging you all to think about taxes proactively throughout the year. See, the average person is going to come to me in February of 2026 and ask, how can I reduce my 2025 tax bill? And as you can see, that creates a problem by itself because tax planning season is something that we have to do throughout the year. So I just wanted to point that out. Tax prep season is coming up. Tax planning season is throughout the entire year. So right now, with a couple more weeks left in 2025, I'm going to give you all some strategies that you can quickly implement to reduce your tax bill before the end of the year. Now, this first one of the seven, it was five. I wanted to expand it to you all to give you the most value today. It's very simple. I'm going to start off with the simple ones first. And it may look simple, but it's to clean up your bookkeeping. The reason why is you cannot deduct what we don't document. You see, a lot of business owners and the vast majority of ones I work with during tax time, when it's time to file your taxes, I can't accurately tell you what your tax bill is or help you plan because you can't accurately tell me what you spent on your business. Remember, as a business owner, you don't pay taxes on what you bring in the door. You pay taxes on what's left after all your ordinary and necessary expenses to operate your business, but we have to figure that out. So for you business owners, especially as the year is getting over with, don't wait until February to start going through bank statements. This is the perfect time to do it now. Start going through your credit card statements, your balance sheets, your bank statements, and figure out how you can categorize your expenses. So now when it's time to file taxes, we got an accurate snapshot of how much you owe. And most importantly, it's good now for audit protection. a lot of business owners, and we'll go over bookkeeping best practices later, but this is just a reminder that if you have a business and you think, all right, this has been a very profitable year, I encourage you all to use the next few weeks before the month is over to figure out what your actual net income on your business is. Number two, this is for your new startup, your new businesses here, right? You need to get out of startup mode. The reason why is because it's perfectly fine to have thousands of dollars to start your business, right? A lot of business owners, we invest 5, 10, 15, even $20,000 in the first year of our business, which is perfectly fine. But in order to use 100% of those losses, especially those of you with W-2 wages, you can use those losses to offset your W-2 wages to reduce your tax bill. Most importantly, get you a refund that you can reinvest back into your business. But you can't do so if you don't know your expenses. But most importantly, if you're still in startup mode, meaning if you haven't made a sale, there's a limit on the amount of losses and expenses that you can potentially take on your tax return. Then you can only take 5,000. Then you got to spread the rest out over the 10 to 15 period. We're not trying to do that. So if you're here today, you have a new business owner, you spent 15, 20, $30,000 in expenses, let's get aggressive. Let's try to make our first sale, holiday sale, Christmas sale, Black Friday, Green Friday. There's plenty of holidays coming up. Let's try to make a sale before the end of the year. So now you could take the losses to offset your W-2 wages and put more money back in your pocket. So those are the first two. Clean up your books, get out of startup mode. Now, for business owners who do have a profitable business, those of you who are not in startup mode and you do have a profitable business, I just want to remind you all about the importance of being able to build wealth within your business, but also get a tax deduction. So for those of you who are the only owner of your business, right? You're the only owner, you're the only W-2 employee. It's okay to have contractors and people that do small projects. But if you are a business owner, don't forget that you can contribute up to $70,000 towards a SEF IRA or a solo 401k. The average American with a W-2 job, you can put in $23,500, then your employer has to match it, right? But you as a business owner, we can contribute up to $70,000. Not only will you get a $70,000 tax deduction, but now you're in a position to build wealth a whole lot faster. So for those of you who may not have $70,000 just ready to go towards retirement, I want you to just keep this strategy in your back pocket, especially if you haven't been contributing towards retirement. I know a lot of times when we first start a business, it's kind of hard to put money towards retirement. You got to take care of a whole lot of other things, right? So keep this one in your back pocket. So with this one, remember, SEF IRA, solo 401k, you can contribute up to $70,000. And what I love about this strategy and the importance of having this conversation now is you can set this account up today. And depending on which one you pick, you have until you actually file your tax return to make the contribution. So what that basically looks like is I might not want to give them $70,000 towards my solo 401k, but when it's time for me to file my tax return because I set the account up in November and I'm about to file my tax return, they say, oh, I owe 15,000. I'm gonna have a conversation with myself and say, hey, instead of giving this money to Uncle Sam, I'm going to contribute this money towards my retirement account to reduce my tax bill and worry about the taxes down the road. But at the same time, I'm building wealth. Does that make sense? Hopefully it does. We'll go over questions in a minute, but this is one of these things to have in your back pocket. This is one of those accounts you just need to have to set up, and then we can worry about making contributions in January, February, March. And for those of you who filed an extension, you can potentially have up until October the next year, but that's another story. So those are the first three. The next is one of my favorite is deduct business travel. And the reason why this is on it, not to go over the, oh, go on the family board meeting, the annual meeting. This is just reminding you all, because this conversation is about year-end tax strategies, is it's not about when you go on the trip. It's about when you spend the money for the trip. So I know I have a conference in Vegas in April, maybe a few $1,000s. I'm going to pay for it in December. You know why? Because I'm going to get the deduction on my 2025 tax return, and I'm going to go to that conference in 2026. So just keep that in mind. I squeezed this one in here just to remind you that that is one of the ways that if you know you got some expenses coming up, especially related to business travel, you can definitely prepay those expenses before the end of this year, get the tax deduction, and take a trip next year. So here are some of my favorite ways to write off trips. Number one is to meet with a client. I have a virtual tax firm. I'm currently in Colorado. Every time I go back home to Illinois, or I go to Las Vegas, or I go to California or Florida, I am meeting with a client so a portion of that trip can be deductible. Number two, attend a networking event. Eventbrite is one of my favorite websites to go to. You can literally go to any city around the world during that trip, type in events near me for realtors, events near me for cater, like DJ services, any service you in an industry, you can find a networking event there, attend it. And not only would that be 100% deductible, but the expenses associated with it too as well. Another one, work during vacation. Now, I believe in separating vacation and business at the same time, right? But for those trips where you are going home for the holidays, or you are going on those trips where your friend works from home or your family work from home, and you're going to take your business and work from there too, as long as you work for more than 4 hours during the work days, you could technically deduct that trip too as well. So have your meeting with your CPA, meet with a client virtually, meet with a client in person, but do work during trips. And the last one is these quarterly board meetings. Just want to remind y'all, do this every year. Is as a business owner, you can have an annual board meeting anywhere around the world. Just like these large corporations go all over the places, they go to these resorts, fancy. You can do the same for your business, but you have to document the process. Don't just say, hey, I went to, I'm going to say Gary, Indiana, I had my board meeting. No, don't do that anyway. But don't just go to, let's say, the Bahamas and say, I have a board meeting. Actually document the process, right? So one hack here is to plan holiday travel and business meetings around holidays. And most importantly, get your friends, your family, your loved ones as part of your board. You don't need to hire them within your business. That can get messy fast. But if you have them part of your board, you take these trips, you document it. Hey, for the first 2 days, we had a team activity. For the second day, I went over my business plan for 2026. We documented it. Like if you have your board meetings, a portion of that trip can be deductible too as well. So before I go to the next step, any questions on any of the first four? You can come off mute. We're going to do questions at the end, but just in case anybody has a question. All right. All right. Okay, cool. Saving for the end then. The next one, shift business income and expenses. Now, that might sound illegal, but trust me, it's going to make sense in a second. So, if you are a business owner making less than $25 million, you're technically a cash-based business. Now, what that means is that income is taxed when you actually receive it, and expenses are deductible when you actually spend the money, even if you swipe your credit card. So this is for my clients who are waiting for, I got a lot of clients who, towards the end of the holidays, they realize, oh, my tax bill is a lot higher than expected. But I also have this $30,000 check coming in from the adjuster that's supposed to be here on New Year's Eve. Well, don't cash that check. Cash that check on January 1st. So then now you got to worry about that lump sum of cash not being taxable in 2025. You have the entire 2026 to reduce that tax bill. So just remind you all that even though you may have performed some work, it's not taxable until you actually receive the money. So if you know you got a lump sum of cash coming in and your tax bill is already out of your budget, it's perfectly fine to delay those checks towards the end of the year, a few days, and then worry about the next year to reduce the tax bill. And the same thing with expenses. When I say shift the expenses to the year that benefits you the most, prepay expenses. If you know your tax prep may cost a couple $100, if you know you need to give your team a bonus, if you know you need to prepay some of these subscriptions and softwares that you have or legal fees, if you pay that in December, even though you're going to get those services in 2026, not only is it going to give you a tax deduction, but you're prepaying those expenses. And 9 times out of 10, when you're paying whole, you might get a discount. So just keep that in mind, especially those of you, I got a lot of people who accidentally report money that they didn't receive as income on their tax return, and then they forget it, and then the next year they report it again. I just don't want nobody here to get double taxed. So just keep that in mind, right? If this is you, cash-based business, it's taxable when you receive it, and it's an expense when you actually spend the money, even if you're swiping your credit card. Next is donor advised funds. Just a show of hands. I don't know if you could do thumbs up. Does anybody here donate to charities on a frequent relative basis, monthly basis? Okay, I see one. I don't see everybody, but I'm assuming Larry, hope you're not the only one. But if you are, I guess it's for you. But with the donor advised funds, this is one of the strategies that I personally just started implementing for my clients. So the reality is, we all know that for the most part, that donating to a charity, you could potentially get a tax deduction. But heavy emphasis on potentially, because most people don't know that when you file taxes, you either take the standard deduction or you itemize. Now, what that means is that everybody gets the standard deduction for automatically filing their tax returns. So if you're single, for tax purposes, you get an automatic $15,750 in tax deductions. And if you're married, you get double, which is around $31,000. That's an automatic deduction you get just for filing your tax return. So if you're married and your household income is $150,000, you get an automatic $30,000 deduction, and your taxable income is really $120,000. It's the difference. And the reason why I point that out is because a lot of us contribute towards retirement accounts. I mean, sorry about that. A lot of us contribute towards these charities, but we don't get the tax deduction because we take the standard deduction. But with a donor advised fund, it ensures that you itemize. And what that means is the itemized process works is if your mortgage interest, you own a home, your property taxes, your medical expenses outside of premiums, if the amount of money you donate to charities, if all of that in combination is greater than the standard deduction, then you take the greater of the two. The problem is most people take the standard deduction, which is more beneficial. Now, when I'm getting at with donor advised funds, this is unique for those of you who donate frequently to 501(c)(3) organizations or your churches, not GoFundMe's. But this allows you, if I know, hey, I'm going to donate $1,000 a month to my church, $500 a month, whatever your budget is, but I'm gonna use 1,000 to make it easy. I'm gonna donate $1,000 a month to this non-for-profit organization every single month, but I want the tax deduction now. I can give my 12,000 for this year. Then next year to this donor advised fund, I'll get the $24,000 tax deduction on this year's tax return because I'll be eligible to itemize. And I can still tell that donor advised fund, hey, I gave you 24,000, but give this organization $1,000 a month. Like, don't give them the full amount, give them $1,000 a month, but I can still take the tax deduction today. This may not be the best route for everyone, but I have clients who get lump sum cashes, bonuses in December, and they're trying to figure out what to do with the money. Well, if you know you're going to donate, might as well just give it to a donor advised fund, get the deduction today, and then you get to determine when the charity actually get the money. And the beautiful thing about this, for those of you who have RSUs and get stocks from your job, you can also donate stocks. So if you got Tesla stock or you work with NVIDIA, one of these tech companies, and the stock has appreciated super high, well, you can donate that stock. Not only would you avoid capital gains, but you'll also get the deduction for the appreciated value of the stock. Now, that may not apply to everyone. So if you have questions, bring that up at the end. But the last one I wanted to talk about out of the 7 that I chose to bring up is the family management company. Now, this is simply just for those of you with kids and you want to hire them within your family. But the beautiful thing about a family management company is for your family. This includes nieces, nephews, grandkids, kids. The rules vary based on how old they are. But with a family management company, this allows you to shift income to a lower tax bracket by paying your family. So I have a lot of clients with daycares, a lot of clients with carpenter businesses, barbershops, and some of them may be in multi-six figures. They're in the 35% tax bracket. But then they realize that, hey, I can pay my kid, each kid, up to $15,750 each per year. And not only is that tax-free income to them, if that's their only source of income, but I also get a tax deduction. So that's just something to keep in mind. If you have kids within your family, younger children, a family management company is the way to go, but you got to document this process. A lot of times we just smack it on our tax return. No, you can get away with that temporarily, but the IRS will audit you down the road and you're going to lose every day of the week and twice on Sunday. So the way you do this is if you have a business, one, make sure that they actually perform work within your business, right? Marketing, social media manager. I got people shredding paper. I got my brother owns a barbershop. My nieces are in sweeping, doing the cleaning, the maintenance, right? Property managers, if you own real estate, you do that. That's real work. After that, maintain their actual hours work and job description. Like treat them as if they were a real employee. But the most important part is that the money must come out of your business bank account to their personal bank account. As parents, I don't have kids yet, but as parents, I can imagine you're taking care of your kids anyway. So how about we get a tax deduction during the process, give them the money, and because they're still minors and kids, you're still going to control the money. You can still do whatever you want to do with the money, but you create the paper trail, business account, their personal account, and then you can use that money for whatever you want to use it on already, but at least you have the paper trail and the documentation to make that happen. So any questions on any of those 7 steps before I go to my bonus tip? Anybody, any questions on that?
What's the age limit?
Yep. So the age limit, so the rules just change different. So if you have a child, your child, son, daughter, under the age of 18, you don't have to pay Social Security tax to them at all. You can just pay them directly, right? So there's no age limit, but the one thing to keep in mind is that it all depends on their total income. So if you have a kid that's 28 years old and they also have a job, that $15,000 is going to get added to their income, and then they may have to pay some taxes on it. But if they're making 100,000, you making 600,000, then who's in a lower tax bracket, you still get some tax savings. So there's no age limit. Most kids get started closer around the age 6 to 8 is when it's kind of like justifiable. I don't know too many 2-year-olds that got a full-time job making 15,000 a year, but I've seen it. I've seen it. I got a client who has a dentist, a family practice, and her kid is all over social media. And best believe she's getting paid. That money is going to W-2. She's putting that money into a Roth, and she's going to use that money down the road to purchase a home or go to her education expenses. So hopefully that answers, but not really an age limit. Just make sure you document and actually do your due diligence. So that's that part. Lastly, bonus tip, I always mention S Corps, but I love taking this opportunity to mention it because this is one of the simplest ways to significantly reduce your tax bill. You see, as a business owner, we pay federal tax, state tax, depending on what state you're in, Social Security and Medicare. That's an additional 15.3%. But with an S Corp, there's a way that you can reduce the amount of self-employment tax that you pay. Well, one thing I want to clear up is that a lot of times we hear S Corp and we're like, hey, I need to form a new business. I just want to clear the air and let everyone know that S Corp is a tax election status. So if you have an LLC or a C Corp, you can reach out to the IRS and say, hey, I want to elect for my business to be taxed as an S Corp. Same EIN, same business. You're just letting them know, hey, I want to be taxed as an S Corp, right? But in order to do that, you need to have an LLC or C Corp already. See, a lot of times, especially I work with a lot of realtors, they have a super profitable year. Tax time will come around. They made $80,000 in profit. They got a $30,000, $40,000 tax bill. And then I can't really help them because they never had an LLC set up. Because one thing you can do with an S Corp is that you can retroactively apply the S Corp status to the beginning of the tax year. So for those of you back to stage one, you clean up your books and you realize, oh, I got a $100,000 profit. First of all, where did the money go? Second, how am I going to pay Uncle Sam? I don't have the money. Well, this is one of those strategies where you can implement in November, December, even January, February, if you speak with a qualified tax professional before the year is over, so we can help make this happen. So just wanted to point this out. S Corp, super powerful. You can retroactively apply. And for those of you with LLCs, remember that LLCs aren't necessarily that what you form an LLC for the limited liability protection, the audit protection, and then the ability to elect to be taxed as an S Corp down the road. So that's one thing. And the way it works for S Corps is basically one is best for businesses when your net income is between 40 to 50,000. I'm either going to up it and I'm going to say 50. And when I say net, I'm talking about after all you pay for all your business related expenses. If your net income is north of 50, then it's worth looking into. The reason why is because when you do form an S Corp, one, tax prep fee is a little higher. Two, the one thing that's get left out, and a lot of people form S Corps and they don't stay compliant, is that you have to pay yourself a reasonable salary. We'll talk about how to pay yourself as a business owner in a moment, but remember, if you have an S Corp, you have to pay a reasonable salary to yourself. Because what happens is, without an S Corp, if you make $100,000 within your business, you got to pay 15.3% in taxes. That's $15,000 in taxes. But with an S Corp, you only pay self-employment tax on a reasonable salary you pay yourself. So if you're making $100,000 and your reasonable salary is $40,000, well, you only pay self-employment tax on that $40,000, not on the rest of your income. So hopefully it makes sense. Relatively straightforward process, but once your net income is above 50,000, you know you got an LLC set up, you partnership in some special cases or a C Corp. That's when we could talk about S Corp. So before I go over payroll and bookkeeping best practices, was everything clear on that last slide? Any questions?
It's
Okay.
a question in the chat, Darian.
Okay, thank you. Question in the chat. Do they have to be on payroll or a simple 1099? Tonio, I'm assuming you're talking about your kids?
Yes, for the kids, yes.
Yep. So if you have a single member LLC, then you can literally just add them as a contractor in your business, and you don't even have to give them a 1099.
Okay, nice.
If you have an S Corp, back to what I just said about this is that with an S Corp, you have to pay yourself a reasonable salary. And when you pay a salary, you have to pay Social Security and Medicare tax. So if you were paying your children out of your S Corp, that's when you actually will have to go in there and run them as a W-2 employee, which is why you create a family management company. So you got your S Corp, and then you got your family management company, which is a single member LLC, and then you could pay your kid from that entity, right? So that's how you would do it there. So it just depends. It's pros and cons to both too. You can just give your 8-year-old a 1099 or not give them a 1099 if you have a single member LLC, but you did the paper trail, right? You got the documents, you transferred it to their business account, you paid them. But if you're like, hey, and you're a financial advisor, so I want my 8-year-old to be eligible to have a Roth IRA. So in that case, you would give your 8-year-old a W-2. So now they have earned income and now they can invest and max their own Roth IRA out and they can build off compound interest and go towards retirement starting at the age of 8 versus most of us 20, 30, 40 years old.
Nice. I love it.
Yep,
Thank
yep.
you, brother.
Yep, no problem. So it just depends on your unique situation, but just keep in mind if it's your child and they're less than the age of 17, so 1 through 17, however you want to put it, I guess 0 through 17, you don't have to pay any Social Security tax related to them as long as you're paying them out of a single member LLC. So that's that part. Any more questions before I go over bookkeeping and payroll best practices?
It's more in chat.
Okay, got you. Yeah, I don't get chat notifications that pop up, so anytime they pop up, I appreciate that. Thank you, April. For travel expenses with just gas traveling to and from the office, what is the rule behind that? When you say to and from the office, is this W-2 office or a business office?
A business office.
Okay, got you, got you. Okay, got you. So the way it works with auto expenses is you got two options. You can take the mileage method or the actual expense method, right? Last year was like if you're driving to the office, you're going to Costco, you're going to meet with a client, you're going to showing as a realtor, you get 67 cents per mile. That's how it was a year or two ago, and it's going to go up every single year, right? That's the easiest way to do it. You just keep track of a business mile. But for others who drive a lot, or you got two cars and say, hey, this is my flashy car when I go outside for business, and this is my Toyota that I'm gonna get around from point A to point B, right? So what happens is it's all based on mileage. So mileage method is one. The second is you look at what is my business mileage compared to my total mileage. So if I drove 6,000 miles business and 4,000 miles personal, so a total of 10,000 miles, that means 60% of all the other auto related expenses related to my car is deductible. Gas, oil, repairs, lease payments, right? Tolls. Those things now become deductible, but it's all based on the percentage of usage that you use your car for business. And whatever method you pick, you have to stick with for 5 years. So if I look at your last year's tax return, I seen you've been doing the mileage, but I noticed, the other method is better. It kind of, you can't take advantage of it. But to answer your question, yeah, you get one of those two options. It just depends on how much you actually drive your car. Does that answer the question?
Yeah, thank you.
Yep, yep. And another thing on the auto expenses, bonus depreciation. We do another webinar in January with like actual tax deductions, but like I know y'all probably seen the videos about writing cars off or saw that. Like all of that is possible, but you have to actually take the actual expenses related to your car. So for those of you who do drive a car, 80% business, 90% business, or 100% business, maybe taking the actual method is the best method because you get to depreciate the entire value of the car over a 5-year period. So if you purchase a car 50,000, right, you get a deduction every single year to account for the value of the car, but it just depends on your unique situation. So any more questions before I go over bookkeeping and payroll best practices? Got it, got it. All right, cool. And I'm gonna keep these simple, fly through it because I want to open the floor for questions. Bookkeeping best practice. Rule number one, you got to keep receipts for at least 3 years. And it doesn't have, I remember growing up, my auntie used to keep receipts in a plastic bag in the back seat. We don't have to do that no more if you're still doing it. You can literally just take a picture of it, send it to yourself, save it within a folder. But big picture is we need to have those receipts. The reason why is because that's the number one layer of audit protection. I know we have bank statements sometimes, but the reality is a lot of business owners I work with, you commingle funds. You see, when you have an LLC, you have to remember that you have to separate business and personal. Otherwise, that limited liability protection that you signed up for is out the window. So if you're a business owner, get in the habit, keep those receipts. I have 2 phones. I take a picture. I send it to my email, my assistant. I take a picture. I put it in a folder. But get in the habit of doing those. And if you are out eating with a client or a CPA, write on the receipt, hey, dinner with CPA, dinner with realtor, and document those processes. So if the IRS ever come knocking, you got all those receipts. So that's the first thing. Second layer of protection is the bank statements. But if you commingling funds, you're just wasting your time there. It's going to be a headache by itself. Second, now that you've been keeping receipts, keep track of your expenses. Actually categorize it. I have people come up to me and say, hey, I made 200,000. My expenses is 80,000. I'm like, okay, what did you spend that 80,000 on? I don't know. So if that's you, it's okay. What I want you to do is I want you to categorize those expenses. One, you can do it via Excel. I started off there 4 years ago before I started my business. And I got a lot of clients who do it. You have a simple business, you got one real estate property. Literally, I brought in this amount, I spent this on supplies, property managers, mortgage interest, like document it. So when tax time come around, it'll be a lot easier for us to see it. If you do have a business and it's like, hey, that's taking up a little bit more time, I'm not really tech savvy, you can hire somebody on Fiverr. Fiverr is an outsourced company that you can go to and get literally anything done for nickels on the dime, right? You outsource bookkeeping, you can outsource payroll, you can outsource video editing. It's very good if you have a simple situation. But once you start getting more complex, that's when you need to hire somebody, right? So Excel, Fiverr, and the third option is QuickBooks. QuickBooks is zero. That should be the go-to platform for those of you, especially those of you in the multi six-figure range or creeping up past 40, 50,000. Like that is what you need to have, because what you do is you simply just link your business bank accounts, your business bank account, business credit cards to QuickBooks, and it helps all the transactions pop up on there, and you just go in there and categorize. So if you ate at McDonald's, went to Menards, with the Amazon, it'll know supplies, it'll know maintenance, it'll know meals. You just go in there and you categorize it. Very easy in the beginning, but when you have people who have thousands of transactions a month, it can become a headache. And a lot of people have QuickBooks and they don't categorize these things. And then when tax time come around in February, they have to clean up all of 2025. And I don't know about you, but I don't know where I spent all of my money in March of 2025 as of now. So it becomes very difficult to clean your books up. So that's just a bookkeeping best practice. Keep receipts for at least 3 years. Separate business and personal. Upgrade to QuickBooks when your business is ready, but most importantly, get in the habit of documenting your expenses. So next is payroll best practices. Now I'm gonna wrap up with some tax deadlines. If you don't have an S Corp or a C Corp, you do not have to pay yourself a W-2 salary. I repeat, if you don't have an S Corp, C Corp, and those of you with a partnership, LLC, multiple members, you should not be issuing yourself a W-2. The reason why is because you're not required. If you are a sole proprietor, meaning you're a business owner, a contractor, Uber driver, a realtor without LLC, well, you're going to get taxed on the net income of your business no matter how much you pay yourself. You can have an $80,000 a year and not pay yourself a penny, but you're still going to be taxed on $80,000. So just running a salary for yourself, you're going to be overpaying in self-employment tax throughout the year because you're not required to do it. So if you have an LLC, you're a sole proprietor, you don't have an S Corp, C Corp, no W-2 wages, and don't issue yourself a 1099, you don't have to. Number two, if you do have an S Corp or C Corp, that's when you actually run payroll. With an S Corp, you have to pay yourself a reasonable salary. Reasonable meaning just because I made 100,000 don't mean I need to pay myself 100,000. I can pay myself a $40,000 salary and it's still my money. I want it now. I can take an owner's draw whenever I want to, but you don't want to overpay in self-employment tax by giving yourself a $100,000 salary when you're not required to. So those are two things. Don't give yourself a W-2 or 1099 if you don't have an S Corp or a C Corp. And if you have an S Corp, run a reasonable compensation. And those of you with a C Corp, please run yourself a payroll. And remember that any additional money you take out is considered dividends. But I just wanted to point those out. And then step 2 and 3 is just mentioning owner draws are not deductible. So if you do have a single member LLC, or if you have an S Corp and C Corp and you're just, well, S Corp and a single member LLC and you're just taking money out, a lot of times I'll look at clients' books and I'll see wages was 50,000. And I'm like, okay, give me the ADP, give me the Gusto, give me the payroll reports. Oh no, I just transferred the money to myself. Well, that's not a business expense. It's not a business expense. So don't put that as an expense on your profit and loss statement because that's not deductible because that's money you took out for yourself. And lastly, you could just pay yourself via Zelle, ACH, a check. Obviously, Zelle is probably the most beneficial, but just wanted to kind of point those out. Any questions on the payroll part before I go with some key tax deadlines? Okay. I'm gonna check the chat too, just in case. Okay, looks good. All right, so these are some of the key tax deadlines that I like to just point out before the year is over. Number one, estimated tax payment deadline is December 31st. Remember, as a business owner, we're not required to pay taxes every 2 weeks, as if you had a W-2. We're required to pay taxes on a quarterly basis. Why? As I mentioned in the beginning, taxes are what fund governmental programs. They got a budget, they got a quota to meet, and if you don't pay quarterly tax payments, you're going to get penalized. It may not be a lot for somebody who only owe 1,000, 2,000, 3,000, but I have clients who come to me during tax time and they owe 50, 60, 70, 80. And if you look under that little tax balance that you owe on the second page of your tax return, it's going to be a $2,000 penalty. that could have been avoided if you know, hey, I'm a owe $50,000. Let me split this up and pay them quarterly throughout the year. Some people got different opinions about it, and there's different ways to go about it. But just want to remind you that if you are somebody who's been making quarterly estimated tax payments, and it's not just for business owners, if you owed more than $1,000 last year, you're supposed to make quarterly payments too as well. So keep that in mind if you want to. If you can, make that payment before the end of the year. Most importantly, meet with us so we can teach you how to get that bill down, and then you ain't got to worry about it. Second one, tax deadlines. I'll be lying if I said these are official. With the government shutdown and everything that's going on, don't know what's going to happen. However, traditionally speaking, partnership and S Corp returns, that's due March 15th. The reason why is those flow through entities. You have to file that tax return first, and then you file your personal return with your single member LLC, your rental properties, your sole proprietor. You file all that second. So S Corps, partnerships, prioritize that tax return first, because what happens is, and the reason why is, let's say me and Larry is in a partnership. Our business made $80,000 for the year, and we're 50-50 owners. I would get a K1 for 40K. He would get a K1 for 40K. But that doesn't tell us our tax bill, because when you get that K1 and you file your tax return a month later by April 15th, that gets added to all my other income, Wiggs CPA Tax and Accounting income, my stocks, my rental properties, and that determines my tax bill overall. So even though you're in an S Corp partnership, as you can imagine, you and your partner may have different financial situations. That's why you file your partnership, your business return first, and then your personal return. And the last thing on this part, and I see it all the time, and I just made a long video about it, is if you have a partnership or S Corp, even if you didn't have no business activity, still file the return. Because if you don't, there's a $245 fee per partner per month that's going to add up. So if you have a partnership and you're like, hey, I'm saving it, we haven't started using it yet, and I really don't have no expenses, which you most likely do, still file that blank tax return for informational purposes, because I have at least 5 people call me in the last 6 weeks. Hey, I owe $3,000, but I didn't make no money within the business, where you still have to file for compliance purposes, right? And then for those of you with W-2 employees, 1099 folks, make sure you issue those forms by the end of January. If you're using a payroll software, ADP, Gusto, QuickBooks, and the thousands others that they have, those will automatically be sent out before January 31st, but you want to double check, right? And remember that if you paid anybody over $600, that amount is going to go up. They keep changing the threshold. You have to issue them a 1099 NEC. That's a form for non-employee compensation, right? That's saying, hey, I have a business. I paid Patrice $1,000. So I'm getting a deduction. Now she has to report that $1,000 on her tax bill, on her tax return, but because she's a contractor now, she gets to write off expenses to offset it. But it gives you an extra layer of audit protection, helps you stay compliant. It essentially moves the tax bill to somebody else, right? So make sure you do that. Lastly, S Corp owners, pay yourself a reasonable salary. Common question I get is, you said I can retroactively apply to S Corp status at the beginning of the year, but I haven't ran payroll. So a lot of times, especially accountants, the ones that's very aggressive with tax planning, they will get you to form an S Corp in January, February, March when the year is over. But they don't tell you that if you were to get audited because you didn't run any payroll and didn't pay yourself a W-2 wages, you're not compliant. So the IRS could technically call you and be like, hey, you made $120,000. We get that you're S Corp, but you didn't run yourself a reasonable salary. So because of that, you were supposed to run yourself a reasonable salary of $60K. So you owe us a $12,000 tax because you wasn't compliant. Now, I haven't seen that happen too many times, but I just want to keep that in mind, that if you do plan on becoming an S Corp before the end of the year, you have to run payroll before the end of the year. Now, what that means is, and I can break, it could be a whole conversation by itself. Reach out if you're in that situation. Just want to remind you that we don't just try to run one big payroll before the end of the year. May not be 40, 50K, but you want to give them something to keep them out of your pocket. So stay compliant, and then the next year we can get you on the right track. So not to hit too much on that one. The last few that I want to hit on is the payroll taxes. Just double check those again, taken care of. The BOI reports. I know last year, this time it was a big deal. If you didn't file, it's a $10,000 fee. Don't get scammed. This is no longer required. Also, if you're getting random notices in the mail about different bills you got to pay for your LLC, and you ever have questions, reach out to me. If you have an LLC, the only fee you're worried about outside of tax prep is your annual report. Make sure you file that. So in Illinois, if you formed an LLC August 21st, 2025, that means by August 1st, the beginning of that month, every single year, you just have to pay a $75 fee. But a lot of time, because your LLC is public information, Scammers get it. And you get notices in the mail talking about you got to pay 100, 200, 300. Don't fall for it. If you have a question about IRS notice, just send it to me. And then lastly, tax planning deadline, December 31st. There's a handful of strategies that you can still implement between January and March. But the reality is, if you want to significantly reduce your tax bill, it has to be done now. So if you're looking to reduce your tax bill, you have questions about that, reach out. But that's pretty much what I wanted to bring up today. So I guess to close it out, just for those of you who don't know, Wiggs CPA Tax and Accounting, as I mentioned, we are a virtual tax firm. We help prep taxes during tax time, but our bread and butter and what we really focus on is working with a very small group of service-based business owners, and we do everything we just said for them. We do the taxes, we do the bookkeeping, we do the payroll, and most importantly, those tax planning meetings. If you were here in the beginning, I say it's 2 different tax seasons: tax prep, tax planning. If you want to really reduce your tax bill, tax planning season is the way to go. So if you have any questions or you're a service-based business and know someone who need help with that, reach out to us and we'd be more than happy to help. And then lastly, stay connected. If you don't, I've got most of your information now, so I can reach out with some details and future webinars. But if you have questions, literally wigcpa.com. Here's my email, my number. We try to post educational reels 3-4 times a week. But I'm an open book, especially before tax time. It's a little bit easier to just call and reach out and get a quick response. But I'm all ears, and let me know how I can support you all. So thanks again for your time. I'm gonna open the floor back open for questions. And yeah, any questions related to tax, business, legal, I'm all ears. So thank you again. Thank you again.